Record. All right. And I'm going to apologize in advance because it's like 4th of July weekend. And if you hear fireworks or some other dumb shit going on, then I'm just going to apologize in advance for that. No dog or creaky chair. Yeah, well, she's taking her midday nap, so. All right, so let me go ahead and share my screen. Or leaf blower, yeah. Share my screen. Okay, we'll do a couple of tests first. So if you want to view it, just double click my name and you'll see my screen. Yeah, I can see 6 people are viewing it. Okay, and then let me do one more test here because I'm bringing back the Wacom tablet, guys. So we'll do that. Boom. Can you see that? Okay, cool. All right, so because this is the first of the series that I'm trying to do, I wanted to offer it 2 weekends in a row because I suspect that by the time I do it the second class, of course, as soon as I start recording, the dog comes out. But I wanted to offer it because I'm sure the first time through it might be a little clunky, and then if you want to watch it the second time, you're more than welcome to join next weekend as well. But the whole point of this lecture series is to start with a really to start and focus in on the whys and hows of market movement. And in my opinion, one of the best ways to understand why and how markets move is through trading range analysis. So what do we got here? So first, let's go over what this course isn't. Okay, in case you had any preconceived notions. This is not going to be personalized trading guidance. This is not a course on risk management. I mean, I'll briefly touch on risk management, but it's not to be misconstrued to be a strictly a course on risk management. That's also not a course on how to read random indicators. The only indicators we'll be looking at is volume, if you consider volume to be an indicator. And we won't be going over random altcoin market predictions. But what we do have is the goal is we're going to understand some important concepts. We'll start with supply and demand because that's the fundamental principle of all trading range analysis, is just even understanding what supply and demand really are. I think people have a general idea, but within the context of market movement, I think there's probably some holes that we can fill in. We'll also go over how to read volume and price action, and specifically how they are related. When you're doing trading range analysis, one of the first things that I always see people do wrong is, they'll start labeling a trading range and they'll completely ignore volume. And in my opinion, the volume is the key. It's the key detail that marries the price action with the context of the trading range. We'll also go through like the basics of market cycle theory, not terribly in depth, but we'll stay basic, understanding the different phases of the market, what are the hallmarks of those market cycle stages, and finally we'll go over more in depth as we get to the accumulation, the reaccumulation, distribution, and redistribution phases of the market. Okay, so first let's start with supply and demand. So supply and demand, we can just think of it as a great time to bust out the Wacom tablet. So quite simply, supply is what holds the market down, right? No secret there. And demand is what pushes the market up. When we have supply and demand at an equilibrium point, that is considered, market price is where supply and demand are at equilibrium. And of course, throughout the day, this will change. It'll go up and down. This market price will vary. I'll put that in quotes, market price in quotes, but it's market price is going to be considered where supply and demand are at an equilibrium, because at that discrete moment in time, supply equals demand, and we have a mutual understanding of what fair market price is. When we go through our supply and demand analysis, we're going to talk a lot about candle spread and candle volume, and all that is, volume speaks for itself, but within a given time frame, say, for example, we're looking at a daily time frame or a 4-hour time frame. When we say the word time frame, this can mean one of two things, right? First thing, when people, especially when you're first learning how to read the market, when they hear the word time frame, I'll just abbreviate this as TF. They think, how long? Meaning, are we talking a span of a week, a span of 2 weeks, a span of a month? And in my opinion, this is the wrong way to look at it. Specifically for supply and demand analysis and trading range analysis, and rather what we should look at a time frame as is not how long, but periods. We can look at them as trading periods. Okay, so rather than saying over the span of 1 week, we say over the span of a trading period, and a trading period can be whatever period you're analyzing: 1 minute, 15 minute, 1 hour, 4 hours, daily, whatever your preferred time frame of choice is. But just for the purpose of clarification here, when I say time frame, I'm not referring to a span of time. I'm referring to discrete trading periods. Okay. All right. Oh yeah, and I'll just briefly touch on the difference between limit orders and market orders, because I feel like that's pretty relevant. So, and of course, if you already know all this stuff, no big deal. I just want to rehash it. So we start with a firm foundation here, and we'll build the house on a solid foundation. So the difference between a limit order and a market order is a limit order is what fills the books. So if we have our fair market price, I'll say market price is here. We have, a list of orders above. A list. First of all, can I just say I'm really excited how straight I'm drawing these lines. This is incredible. But the market price here, everything above it, we have supply, of course. We already talked about that. And below we have demand. But what fills the order book are limit orders, right? So we have standing orders. We have standing buy orders on the downside. Buy. And we have standing sell orders. And the way that market price traverses these buy and sell orders is through market orders. Okay, so market order, what that says is I don't have a specific price in mind. I just want to buy as much as I can right now, or vice versa, sell, right? So if you're at market price, you say, I want to buy X Bitcoin, X ETF, whatever, X quantity, right? X. You will then place a market order, and it will traverse the order book until your quantity is fulfilled and you don't care so much about the price. And this is going to be really relevant when we start to talk about things like liquidity pools, when we start to talk about stops, liquidation prices, those sorts of things. This fundamental difference between limit orders and market orders is going to be really important. Okay. So far, I can't imagine this is terribly new information. If going forward right now, if there are any questions about anything I've said, just go ahead and post it in the chat, and we'll go through it. Because if we're having issues with these understandings now, it's going to be really rough going forward. So let's knock these issues out. If you don't have any questions, just type no. No? Cool. All right, onward. So here's an example chart of, let's go ahead and pull this back up. Here's just an example of some basic price action. And when we're looking at this, you don't even worry about the idea of a trading range just yet. Let's focus just on the price action and on the volume. So when we first look at when we're looking for something like candle spread, what that means is the length of a given time frame period. Okay, so wick to wick, this would be considered the candle spread. The wider the spread, the wider the result. So spread equals result. Oops. When we look at volume, it's important to accompany this spread with the relative volume. And when we look at the volume, this is going to be considered the effort. Okay, so when we look at effort versus result, that is going to give us really strong clues about what is happening within our trading range or within your price action history. And we can start to develop, we can start to compile a list of clues and pieces of evidence as we go and traverse price action, right? So when we look at this idea of effort versus result, effort versus, result. If we think about this in terms of like, I always like to reduce market activity to things that are immediately relatable in everyday life, because sometimes market activity can be a bit abstract. But the way that you should view this is, imagine you're like lifting something very heavy, right? If you move something very heavy with little effort, the likelihood of it continuing is very strong. And vice versa, if you lift something that's very heavy and you're struggling with it, you're going to have a really hard time maintaining the momentum. So within this chart, we can see two specific examples of that. So we see the market kind of breaking this little bit of structure here. I'm going to go over more about support and resistance levels, but for right now, we can quite clearly see these, horizontal levels. The price tries to break above, it's lifting this heavy object here. And here, would be an example of the market getting very tired. Now, that doesn't mean just because you're tired, you're going to drop the heavy object. But what it does mean is, oh no, it might be time to take a break. And if there is a sign of weakness, a sign of a lacking strength, then this is a very vulnerable time in the market, because any further weakness on top of your already exhausted effort can likely yield a reversal, right? And the way that we start to look at these levels here is, once we claim a level, we really don't want to see it given up, especially when it's a new high. Okay. So keeping that in mind, when we look at a chart like this, what are some of the notable characteristics about the effort and result of the trading range? So if you can, just type a response or post a chart or whatever, but just something simple like, what is your first impressions when you see a chart like this, just through the lens of effort versus result and the lens of spread and volume? High volume and spread on the down candles after all-time high. Yeah. So after making this high, it's not the end of the world to give up the high and return back for like this throwback. But what we really don't want to see is we don't want to see these widening candles overtake previously claimed zones. And you can see quite clearly that, again, I want to use this analogy of, you're lifting this heavy object, and as you start to falter, things just start to go downhill from here, because you can see here that these very narrow candles on the upswings, they're occurring on relatively high volume, right? So, they're not super high compared to what you see in the future, but they are outliers in the trend. The trend being this little moving average here, this curve. And we can see that these are very high effort moves. This is accompanied by this. And what we see here is that these are high effort moves, but very little result is taking place here. And it is easily dispatched by the same level of effort with an even bigger level of result. And it happens again here and here until ultimately, the bullish effort collapses. We see this giant downside candle on very high volume. And again here, right? High effort, high result, until it eventually, it finds its bottoming price and forms this little range, and then boom. Right? So from the chat, low volume in relative terms on the green bean from the lows of the range. Yeah. The other thing to note is when we look at these candle spreads, it's really important to look at it in context. Okay. So when I say in context, I mean, it's whenever we're analyzing effort, it's relative to the rest of the price action. Because had we never seen this, pretend like none of that was there, we didn't see any of this yet. These were very strong outliers within the previous market activity. Right? And then we see this very strong selling effort take place to the downside on very minimal effort. Right? And then once it bottoms, we see it kind of tapering out, and we'll go more into what this means a little later. But really, just the whole point of this little section is just to really conceptualize the spread versus volume concept, because these are going to be recurring themes throughout the rest of the class. So let's close this. Boom. And here, another example. We see these very high effort candles to the downside. We see an attempt to rally, but it's on very low effort, very tightly compressed candles. And we can see quite clearly that once it breaks this high, the whole thing just starts to unravel, right? Starts to unravel, volume starts to expand, the spread starts to expand until ultimately the low is broken and we see a downside continuation. Okay? Boom. So here's a bullish example. Okay, so I showed you two bear examples. Here's a bullish example. What are some of the notable characteristics here? This is a question and answer section. Just start listing them out. Just whatever you see here. High volume on the green candles. Yep. Oops. High volume on green. Okay, so I'll go ahead and fix this actually, because the slight difference in terminology matters. Higher volume on green. The reason why I'm emphasizing higher rather than high is because, what did I say earlier? It's all relative. So we see higher volume on the greens. Okay, so what else? Keeps going up with consistent volume. Yep. Consistent volume on move. Low spread on the sells. Exactly. Low spread on the sells. Okay, what else? Not retesting, running pattern. I think you guys are both saying the same thing. Retesting meaning what? Retesting the support. Retesting broken resistance. What do you mean by not retesting? Retesting small breakout points. Only one wick down from each. Yeah, so I think you and Mulzer are saying the same thing, that it's this idea of a running pattern where it's so strong in a given direction that it's not even forming a price floor, right? So like there's never even a level for you to be like, oh, I'm going to draw a horizontal here or horizontal here. It just keeps making this swing low, swing high, swing low, swing high, boom, boom. And the most important concept here is the low spread on the sells. Well, both of these. So star, that's a terrible star, star, star. The higher volume on the green, higher volume on the green, and there's one more thing you guys are missing here. So low spread on the sells, but the main point here is that we're trying to look at this relative to the rest of the price action. What's the last thing we're missing here? Only 1 wick down for each. Oh, I already read that. I'm waiting for the. It might seem obvious, and so you're just not saying it. Lower volume on the sells. Yeah. So I would also consider that. The main thing that we're looking at here is that consolidating upwards. Yeah, we kind of already said that. The breakout. It's even more obvious than that. So we see low spread on the sells. We see relatively low volume, but not only do we see higher volume on the green, we see higher spread on the green. Higher spread on green, right? When we see, can I erase this? Let me see. Bam. Because again, the whole point is that it's everything we're analyzing in a trading range is relative to the price action within the trading range. Okay. When we first started out, and yes, by the way, this is a trading range, even though it's consolidating upward. This is a trading range. It's not a clean horizontal like I would prefer it to be, but this is a trading range where it's consolidating upward, blah, blah, blah. But the most important thing to note is that as the range matures, as the consolidation matures in its upward direction, we see a diminishing bearish effort and an overwhelming bullish effort. So not only do we see the tide shifting in terms of effort, but we're also seeing the tide shift in terms of result. When this trading range first started, this was a little iffy, right? We see this bearish engulfing candle. We see another bearish engulfing candle. So we see a high effort. A high result from the bears. But as the thing matures, this is the key thing. As the range matures, the bearish effort starts to dwindle. And the result starts to dwindle, right? Because obviously it's getting higher lows. So every time they're trying into higher lows. Every time. So main takeaway here. We got the higher volume on the green, the higher spread on the green as the trading range matures. Consistent volume is also nice. If we saw as it moved upward, we saw tapering volume, that might be a sign of concern, a point of concern. But the fact that we see the low spread on the sells and the contracting volume on the sells, that gives us further confidence. Additionally, here's something subtle that no one picked up on yet was on the upward moves, the volume contracts, and on the consolidations, the volume contracts, and on the upward moves, the volume expands. Same thing here. We see this like consolidation that takes place, and it kind of drifts down, and the volume kind of tapers away. Conversely, the bearish counterpart to that would be diminishing volume on the rise and expanding volume on the sells. But we'll get into that more in a little bit. Okay. So, any questions about this so far? Cool. Regarding volume? Okay, what's up? And let me know if you'd like to ask a question with a voice. That might make your life easier if you're having trouble articulating that with with the text chat. So regarding volume, lots of people say because we have lots of exchange volume, volume is less useful. So yes and no. Oh, many exchanges. Yeah. So truth be told, I like to do most of my analysis on spot exchanges. And usually I don't look at Bitstamp. I tend to look at Coinbase because it's the only American exchange that is strictly spot. I think now they offer some sort of leverage product. I don't really know. But the whole point that we're looking at here is we're looking at effort versus result of spot exchanges. Because, yeah, what you're saying is true. But if you follow derivative exchanges like FTX or Bybit or, you know, whatever, they're in general, especially for stuff like Bitcoin, less so for alts, but specifically with Bitcoin, the volume trend still keeps up to pace with Coinbase, which is purely spot, right? Like you'll have some outliers on lower liquidity and lower market cap coins, but for the most part, the trend is pretty consistent. And I'll get into that. I'll get into why I have an argument for that. I think in 1 or 2 sections down the road. Can we assume that the CEO prefers spot when trying to shove the market in a given direction? So for those who, okay, so I'll answer both of those things in a second. Why not Binance, which is the largest spot exchange according to what I know? Because I mean, you can look at Binance. It also reflects Coinbase's volume trend. But I like Coinbase specifically because it's almost entirely unleveraged. And they don't have any derivative products. Binance has, I believe they have a futures market. They have margin offerings. They have a lot of other things on there. Wash trading. Yeah, there's always been suspected wash trading there and other exchanges. Got it. So question is, when I trade Binance margin, it shows on spot. Yeah. So it depends on what pair you're trading. So if you're trading, you know, BTC, USD on margin, that's the same market as the spot market, but what you're looking at is you can sometimes have skewed volume perspectives because of liquidation events or because of one large player with a ton of margin exposure. So it can kind of skew the data, but using Binance is totally fine. In general, like 99% of the time, Binance will match the same price action and volume trend as Coinbase and Bitstamp for the most part. Bitstamp's a little less liquid, but for the most part, Coinbase or Binance are totally fine. Like, just don't overthink that part. Okay. So, all right, so let's move on. And I'm going to cover more of like the reason why I look at spot exchanges primarily here in a sec. All right, so support and look at that. I had a fun little animation. Forgot to put that in there. So support and resistance, right? So support occurs where buying and selling efforts are equal. I kind of went over that briefly, but this specifically doesn't refer to the whole concept of like market price. This just basically means supply and demand are at an equilibrium. And that doesn't mean at a given instant. That means across kind of like a zone of prices. And we'll get into more of what that means. But when I'm laying out support and resistance, I personally prefer to use zones of price action rather than discrete lines. And I'll show you exactly what that looks like here in a sec. So here's an example of a support zone. So we can see that, like, you know, we see all these wicks just kind of all over the place. But as we go to a higher time frame, like the 1 day, it kind of cleans up if we think about support in terms of a zone. And we can see on the initial ascent leading into our market top, there were these two key swing low points. And rather than favoring one over the other, we say this is a zone. And we can think of these zones as zones of confidence. Zones of confidence meaning the further through the support we go, like say, for example, if we start closing candles below here, that is a sign of relative weakness in the market, and vice versa. If we see these wicks into support, a wicking rejection of this zone gives us a high confidence of bullish strength. And the more it starts to droop into this support zone, you can kind of make an argument for it being a diminishing buying effort. And this can get really simple like this, where we look at the zone, or a little bit more complicated like what we're going to see here. So here's an example of not only a support zone, but a series of resistance zones. So when we're looking at the resistance, we, in general, don't really ever want to just take this wick. You want to look at, again, this zone. And we can see, because in this specific example, there was never really a consistent agreed upon price where it was like a price perfectly moved up to this level and got rejected, perfectly moved up in this level and got rejected. It was more of a zone of wicks where the market was trying to decide, are we topping here? Are we going to continue? Blah, blah, blah. And we can outline this zone by, and you can even be more generous than how I have it. It's up to your own personal interpretation, but you can see that this closing and this wick outlined a nice zone. I could even see an argument for extending this zone down to here. Like, I think that would be totally appropriate, as long as it captures the general idea of when we enter into this zone, you're highly likely to get rejected, and if you go through it, you're highly likely to continue. That's the important takeaway here. And we could even do this on all these swing highs. So we see swing high number 1 falls down into swing low, and you can see it forms this zone. And although it has these big wicks through there, at the end of the day, we care about, again, the time frame and the trading period that we're analyzing. So this would be considered more of an outlier, but we can see that at the end of the day, when the dust settled, this zone captures the meat of what we're trying to view here. Okay, and after the swing low, we see the swing high, and we can even make an even smaller zone here. And again, here. But even after all those swing highs, this zone was the point of interest. At the time of, say, we hadn't seen all this yet, this would start to be a zone of concern. Because again, these support zones and resistance zones are they're confidence intervals, basically, right? The deeper we go through the support, the more you should be considering potentially getting out of your long, and the more strength we show out of support, the more confidence you have taking a more speculative bullish position. So here we see quite clearly, we're starting to close below, and that's a point in time where we start to raise some eyebrows. We say, oh no, this is a change from what we've seen over the past few days. This was closing above, and now we're starting to close below. But as we recapture, what do we see? We see expanding spread on the candles. We see expanding volume, and this gives us at least a modest level of confidence that bulls are still here to party, and that bears, even though this had a high volume shove below the support, the buying effort just quickly picked up and the spread widened, and we see the rally out of the support there. Does any of that not make sense so far with the support and resistance zones? Any questions on why I drew the zones the way I did, or why, any questions or observations about the supply and demand aspect of this little range? Yeah, the support zone here. Would it make sense to get it lower so we don't have any close lower? So, do you mean like widening the zone? Like down to here? Yeah, so personally, I don't like to do that because there's no consistent level where the wicks are respecting. But what we do see is that there's a consistent boundary of closes that have a higher confidence. Like I don't know personally where I would, after the fact, we see that it took out this low. But before that happened, like I don't know where the appropriate wick would be. Because if you want to get real crazy, you could just make this whole thing, this block. But at that point, you're covering a significant percentage of price action. And I don't know that that's immediately helpful. Yeah, and also exactly what Mike said. So depending on the time frame you draw them, they can vary. Why specifically 4 hours? That's just what I chose for the example. And in my opinion, for what I trade, the way that I trade, 4 hour is like my mid, starting to lean high time frame. It's just my personal preference. If you chose something like an hourly, you would see something very similar here, right? Because there's 4 hourly periods within one 4 hour period. You'd see something similar. It wouldn't exactly be this zone, but just from my own personal preference, the 4 hour level is what I find to be the best filter of just market noise for these larger time frame, larger span trading ranges. Okay, so also in this case, it respected the zone 3 times. The fourth is probably an outlier, so rightly a point of worry. Exactly. So what he's saying is, after getting respected so many times, especially after the swing highs are getting lower and lower, this is something that becomes a point of worry. But as it reclaims the broken structure, it becomes the worry dissolves, and we start to see that the bulls are absorbing supply, and we'll get into more about supply absorption in a little bit. The first 3 candles of that fourth respected the zone. And those first 3 candles at that fourth low respected the zone. Yeah. So like, especially when we see something break and it comes up and tries to re-break it like this, we see that if we look real closely, a few of the candles actually resisted the zone here before ultimately having this nice bullish engulfing candle send us back above the zone. Anyway, I don't want to get too hung up on support and resistance because we got a lot more to cover. Question and answer period, done. Okay, so I'm not going to go terribly in depth about liquidity and slippage. I'm just going to do a very high level overview. Liquidity and slippage are inversely proportional. So what that means is the higher the liquidity, the less likely slippage is to occur. What liquidity means is liquidity refers to standing limit orders that when a market order sells into them, like if we go back to our prior discussion about market price, so I'll just say MP for market price, we've got standing limit orders above, standing limit orders below. If this order book is sufficiently thick with 2 C's, then a market buy doesn't move the market price too much, and vice versa, a market sell doesn't move the market price too much. As the liquidity dries up, these orders become thinner and thinner. Then the same market buy that was once barely moving the market moves it a lot more, and that act of moving the market price significantly is slippage. Okay. Liquidity pools are a specific point of interest when you have support and. Sorry, can you hear my dog drinking water right now? Jesus. I'll let her finish. Hey, go. All right, sorry. I shoot her off. Oh, you couldn't hear? Okay. I saw my mic queuing, so I wasn't sure. Okay, anyway. So liquidity pools are just the concept that when you have a range of prices or a well-defined support and resistance level. So I'll go back to our prior example. Here, this is a good example. So a liquidity pool is just, quite simply put, when you have a well-defined support level, most people who buy the support level, they will put their stops in logical places. So say, for example, you see this zone here and you got long here, anywhere in here. Most likely, especially if you're trading the daily time frame, most likely you're going to put your stops down here, somewhere in there. And if the price gets shoved down into it, like what happened here, then these stops trigger. So just real quick overview, if you don't know this basic mechanic of markets already, when you trigger a stop loss, what that means is it executes on whatever exchange you're trading on an immediate market order. So if you are long and you set a stop loss, so say you bought here and you set a stop loss here. If the market comes down and hits this price, it executes a market order. But what that does is it creates, especially when we have all these tests of support, it creates a real thick, dense pocket of stop loss orders that can cascade into one another, but it also provides a point of liquidity in a lower liquid market. So as bear markets progress, they become less and less liquid because, overall market participation is down. Less people want to trade, and overall 24-hour trade volume just dwindles. So we start to get these liquidity hunts, and again, real high overview. If you're a very big player and you have a ton of money, you don't want to just market buy them. You don't want to submit a market buy at market value, because when you do that, it's going to shove the price just through the roof, right? So what you do instead is you force the market down into this liquidity pool. I'll call this liquidity pool, LP. You force the price down into this zone. It executes all these market orders. And what you do instead is you market buy, or you have standing orders, absorb these market sells, and it reverses. So we get something like this, for example, where it breaks this low, it triggers all these stops, and then it reverses, quite quickly. Okay. So the only point that I'm bringing this up, I'm not even going over any trade setups for liquidity pools. That's like an entirely different discussion. The only point I'm making here is that these runs into liquidity pools become really important when we get to the tail end of the market cycle. Okay. Any question on liquidity pools? Don't overthink it. It's just a stack of stop losses that provide liquidity for larger players to rally out of. So it's a manufactured support level for big players, essentially, right? Didn't understand this concept by this term before. Thanks. Yeah. And as bear markets progress, playing liquidity pools and identifying them become really important, because as the markets become less and less liquid, the likelihood of doing something like this, where the market comes down and bounces, becomes much, much lower. And instead, what it does is it seeks the liquidity, because the liquidity isn't here. The liquidity is, down in here. where people, they bought this rally and they set all their stops, and the market comes down, dings those stops, and we see this like capitulation bottom sort of thing. Okay. Boom, boom. Okay, so now we're going to get into the fun stuff. The trading range analysis. The market cycle in general, it has 4 phases. We have accumulation, reaccumulation, distribution, and redistribution. And it kind of follows this sinusoidal pattern where at the bottom, the trough, if you will, this becomes the accumulation zone. In the middle, we typically have a zone of reaccumulation where the market regathers. Then we have the peak, which is our distribution zone. And then we have redistribution, typically. And then we have accumulation down here. And these reaccumulations, it's not quite as simple as just saying, oh, we're accumulating, we reaccumulated, now it's distribution. Like we can have multiple reaccumulation events where the market does something like this, it bottoms, then it peaks, where this would be accumulation, reaccumulation, and ultimately market comes too heavy and it it blows off or something like that. So don't think it's as binary as being like, if accumulation, then reaccumulation, then that means logically distribution. That's not how it means. It just kind of goes into that pattern. And the intermediate step between accumulation and reaccumulation is the markup period. And every time, all market period is just the leg up. So if we have some sort of consolidation here, prices, and then it breaks up and it reaccumulates. This here is the markup period. The entire leg up leading into distribution is considered markup. And vice versa, following distribution, we have the markdown period where we have the trading range, it marks down, redistributes, marks down. This whole leg would be considered the markdown period. And so ultimately it bottoms in accumulation. And then it just rinse repeats. Okay? Pretty straightforward, I think. If at any point I'm saying something that doesn't make sense, don't wait for me to ask questions or ask 4 questions. Just ask away, and then I'll look over and I'll see it. Okay. So trading ranges have a specific purpose. And that purpose, I wrote this out, is they provide insight into aggregate strength or lack thereof of demand relative to the supply present in the market. So that's kind of like a word soup there. But essentially what it means is, in general, trading ranges tend to be horizontal, locked price boundaries. We do have some instances of very strong markup campaigns and very strong markdown campaigns where this trading, there's one of the examples we went over earlier where the trading range is so strong that it consolidates upwards. But for the most part, horizontal trading ranges are the name of the game. And the whole point of a trading range is that, again, going into this idea of the liquidity pool and large players and lacking liquidity to get their orders filled, a lot of times very big market players will lock price within a trading range. And what they'll do is they'll say, we have a well-defined upper boundary. They'll move the price down. It'll form a well-defined lower boundary. And then following this market upper boundary and lower boundary, there'll be a series of tests at the lower and upper boundary. And that's where we want to start doing business. And when we start taking out our little magnifying glass and really identifying just exactly what's going on at these tests and the trends in between the tests. Okay. So question, are these zones only known in hindsight? Which zones? Are you referring to support and resistance zones? Are these zones only known in hindsight? So no. Well, okay, so it's more of a work in progress. You start to develop ideas. So as a trading range begins, you don't know what it's going to be. It's like opening up a pack of Pokemon cards. You're like, man, I hope I get what I'm looking for. But at the end of the day, the pack of Pokemon cards doesn't give a shit what you hope for. You're going to get what you get. But what we can do is while within the trading range, we're going to start to develop clues at the boundaries and within the path to the boundaries. We start to develop clues, and as the trading range matures, so does our confidence in marking up or marking down. As the trading range begins, our confidence level is like essentially 0. Well, I don't want to say 0. I would say 10%, because the default assumption is that a consolidation is going to continue until proven otherwise, right? If a trend is up, you don't just want to assume it's like, oh, well, this is the top. You want to have damn good evidence that it's the top. And as the trading range matures, so does your confidence. So does your confidence level. Until it gets, to about a 90%. That's the goal here. We want to get to a 90% so we can place a trade that we're very, very confident in. I don't ever want to say you're going to be 100% because you can't be 100% sure of anything. But as the trading range matures, our confidence level should be increasing. A lot of times, this 10% stays here for a long time. This 10% can stay for the majority of the range until we see something critical happen where we break and come back down, or we break and rally, or vice versa, we break and come back in, or we break and fail to come back in. These critical tests of the upper and lower boundary, as it breaks, this is when the reaccumulation or distribution or accumulation or redistribution, that's when we start to get the most confident clues. These tests, these are just kind of icing on the cake, and I'm going to go through specific examples here, so don't get too hung up on this little sketch that I'm doing. Trading range is usually defined by a selling climax and the automatic rally. Yes, that's right. What are you looking for to see in accumulation trading range? Man, you ask so many good questions. It's a good thing that's the next section. But before we do that, I want to really, really harp on this, because there's a tendency when people start learning trading range analysis to apply it to everything, right? As soon as, they see price just kind of moving around, they're like, oh, this is a trading range. And they try to just they get very, very hyper-focused. Instead of just taking it as it comes, they try to just force trading range analysis. But the number one thing to remember is that it's all relative. The relativity of the price action and volume is the key there. As the trading range matures, we want to look at what's happening at the later stages relative to the earlier stages, right? Is the bearish spread compressing over time? Is the bullish spread widening? Well, that gives us high confidence in accumulation. Vice versa, if we have a distribution trading range and the bearish spread is expanding and the bullish spread is small as the trading range matures, well, that gives us higher confidence in distribution. Okay, so relative and context is everything. The other thing is trading ranges are not patterns. This drives me up the walls. Okay, when you're doing trading range analysis, do not think that all trading ranges take the same form. It's not the same thing as something conventional like a bull pennant. Okay? Trading ranges, reaccumulation trading ranges, distribution trading ranges, they are not patterns that have a very specific look to them. The whole point of trading range analysis is to look at all of the individual parts of the trading range and not try to fit it to some random pattern. Again, don't overdo the analysis. Don't try to apply it to everything. And the most important thing is be objective. Be objective. Okay? Just because you want it to go up, you have to be objective when you're looking at a trading range, because that's the only way. You have to use the clues within the trading range to let it guide your opinion. No matter if you want it to continue up, you want it to reverse,
look at the clues, and that should be the key focus there. Okay, so let's look at the each individual stages of the market cycle, piece by piece. Okay, so primary traits of accumulation. Going back to this sort of thing. Accumulation occurs after prolonged decline in price. Okay, and this is all relative to your time frame. So accumulation can occur on 1-minute charts. It can occur on 15-minute charts, weekly charts, and we're going to look at several examples over several different time frames here in a second. But the key thing is that it occurs at the bottom following a decline. Okay, obviously, right? It's the bottom of the market cycle. This isn't anything profound here. The other thing is that, in general, with an accumulation trading range, volatility tends to reduce over time. This is a really key point to keep in mind here. So what I mean by volatility is, you'll start to see within a trading range, you'll start to see less stop runs. So you'll see less stuff like this where it consolidates here and it goes bang, and it bleeds out, and then bang. With accumulation, what tends to end up happening is the wave, you might have some of that stuff at the beginning, but over time, it tends to smooth out, and then it climbs out of the accumulation range. The other thing is that within accumulation ranges, in general, volume tends to decline over time. Okay? So if you've got your volume here, it declines over time, and then at the later stage of the trading range, when it begins to mark up, we see a massive expansion of volume again, and a massive expansion of price spread. Okay. Oftentimes with trading ranges, the thing that precedes the markup campaign is a shakeout. That doesn't necessarily mean it has to happen, but in general, we see these shakeouts following a test of the upper boundary. So if this is our boundary here and here, we see the market move above, and then it comes rushing down here to try to trap early bulls, bait early bears into shorting. And then that's typically when we see the massive expansion in volume following the shakeout. So let's look at some examples before we take questions here. So here's a really famous example. Okay. This is the 2016, 2015 bull market accumulation trading range for Bitcoin. We see quite clearly, a well-defined trading range. This is sometimes when the market is very illiquid, we see massive outliers in price spread. Like this is a humongous outlier. And so it doesn't immediately make sense to draw your trading range bottom at this capitulation low, because this is essentially just a fight for liquidity at this point. This isn't even support. It's just the price, the market just collapsing on itself. But what is important to note is the reaction off of this break of the support. So this, when we're looking at our trading ranges, we have pieces of anatomy. Okay, this would be considered a selling climax, where we see just massive spread and just large outlier in volume. Typically, we see a swell in volume, but sometimes if it's just so profound, it looks like a giant, just a giant outlier. Okay, so this is our selling climax. Following the selling climax, there's typically an automatic rally or automatic reaction, however you want to label it. And that is just, after you can think of the bottom of the trading range as like a water level. Okay, so here's your water. And if you have a really buoyant object and you shove it below the water, you can shove it, but eventually you can only push so hard before it springs back above the water level. And that's what the automatic rally is. You shove the price too far below the water level and the price rallies above. Because this was such a large outlier in price, typically what we want to do is we keep our selling climax, we label our automatic reaction, but we look at, because this is such an outlier, we look at the second low instead, and that becomes our swing low of the trading range. And typically, as soon as you get these marked points right here, we just slap a parallel channel on here, and we just extend this forever. Okay. Granted, just like I was saying before, at the beginning of our trading range, say we didn't know any of this yet, we only have this piece of information. We don't know if this is the bottom. You can't just assume it's the bottom. You don't know if this is going to form a bear pennant that just continues again, like we've seen that tons of times. We don't know if this is going to form a redistribution trading range. We're in clue discovery mode here, and the real pieces of evidence occur at the upper and lower boundaries of our trading range. We can see, at the beginning, we see high spread here, relatively high volume. We see high spread here, relatively high volume. So this isn't terribly insightful, right? Like, the market is still getting its footing. The trading range is still figuring out like what it wants to be when it grows up. As it matures, it will decide what ends up happening there. So, but the key points of interest are at the upper and the lower boundaries of the trading range. You can kind of make an argument for like this being a zone of some kind if you want to, zone it out. But with trading ranges in general, I like to have it discrete lines like that. There's nothing wrong with putting zones on there. That is totally fine. But I personally prefer this. So, leading into this trading range, up until this point right here, so assuming we don't know any of this stuff here, we don't really know what's going on here. We see little bits of clues. We see big spread to the downside. Volume's not terribly exciting when it's at the bottom of the trading range. We don't see any large expansion of volume on the downside, and vice versa. We don't really see any large expansion of volume on the upside. But where things start to become interesting is as it runs for the test of the upper boundary of the trading range. We see quite clearly large spread on the upside, compressed spread on the reaction of the rallies. And we also see, which is the thing that we really want to see with an accumulation trading range, is as it rallies up, volume starts to expand. So we see this high effort, high result run into the top of the trading range. Now, typically what ends up happening as we reach this, we'll call this the sign of strength of the market. All a sign of strength is again, it's just increase. We're piling on clues here. And what this does is this tells us, okay, there's some real bullish confidence here. Let's see how it handles, off this reaction. We'll see what the reaction looks like. So again, this is all context and relative. So I'll put this up here. Context / relative. You can read that to the price action that preceded it. Okay. And we can see, again, emphasizing this, we see the spread relative to the price action that preceded it quite clearly showing bullish confidence. We got higher highs, higher lows, until eventually we break the top of the trading range, and this is our first terminal test of supply. Typically, when you have your first breach of the trading range, you're going to know pretty fast if it's going to revisit the low of the trading range. If you were just trading this would have been really tempting to say, oh, this is an Adam and Eve double bottom where we have this impulse low, a curving bottom, and it very easily could have resulted in an Adam and Eve double bottom. But what's the real clue here is that once it breaks the top of the trading range, we see it return back inside the trading range. Not only do we see it return, but we see it return on relatively high volume here. So we can see it climaxes in volume, and it gets spat back out. And typically what ends up happening, not always, but what I've found with crypto more often than not is if we fail to break the top of the trading range, we are almost definitely going to revisit the low of the trading range. And what that is again, right, as we're encountering the upper and lower boundaries, these are all tests, right? Test 1, test 2. We can say this is test 3, or maybe test 2.5, right? Test 3, test 4. And what we see on the fourth test is if we return to the range, that tells us there's a very strong chance that we're going to shake out this overhead supply. If we get a clean breakout, then cool. Yeah, we just keep going, no worries. But the return to the trading range, this is what opens our eyes here. We say, oh, this is interesting. Okay, so we see the break at market structure at 0.4, and as it returns to the trading range, there's a very good chance it's going to come back down and take out the lows of the trading range to retest supply. Now again, we're still in clue discovery mode, right? We haven't actually seen a terminal test of the bottom of the trading range. When I say terminal test, I mean a breach of the boundary. The breaching of the boundaries, what really gives us the information. The trending of the spread and the volume is very good, but where the most important clues happen are at the breach of the boundaries and the reaction to those breaches. Okay. So as this range matures, it starts to come down, and we see the price unrelentingly just being forced down. It's like not even retesting anything. It just gets forced, and it's forced. And this is an intentional maneuver to shake out supply. So what we see is we shove and we finally breach the low. And conversely to this, I guess similar to this, we see the breach of the low, but then we see it return back inside the trading range once again with the green candle. And again, just like at the top where it had a high volume reaction, we too have a high volume buying reaction here. So now at this point, we have our strong test 0.5. We say, oh, this is really interesting. So not only did we bust the low of the trading range, we returned back to the trading range. Okay, cool, interesting. This alone, if your first trading ranges isn't immediately actionable, what it does say is, well, we've had a test of the upper boundary, we've had a test of the lower boundary. Something's got to happen here. There's all the information has been gathered. Now it's the decision point. Now we're going to see, are we going to mark up or are we going to rally and dump? And what we see is it just kind of chopping, right? Like at the time, if you were trading this would have been a point of uncertainty. We don't really know. We don't really know if it's just gearing up for another leg down. But what we do know is that with accumulation trading ranges, because the goal is to buy, not to sell, quite often we see below the midline of the trading range, it's like the 50% line, most of the consolidation tends to take place below here. And rather than up here. Why? Because we want to buy low, we want to sell high. If we see the opposite, where the consolidations are taking place at the top, that gives us a little more cause for concern. And I'm going to go over an example of that in a little bit. But at this point, even if you haven't traded any of this, what gives us the added confidence is we start to see this effortless change of character in the market where it stops having these swing lows, right? The swing lows, the reactions off the rallies are getting weaker and weaker. And we see here, following the shakeout, it just kind of does this. And it starts to expand and get crazier and crazier, and the volume supports this move. So following shakeouts, when we see the expansion of volume, we see the expansion of price spread, this gives us a very high confidence that a new bull market is about to take place. So after everything I just said, even if at any point you didn't want to trade the trading range, sometimes people don't trade the trading range, what it does tell us is that a breakout at this point is likely to continue for a sustained period of time. And that is what gives you the edge going into the next leg of the market cycle. Okay, question. So regarding where consolidation occurs, the goal of accumulation ranges is to make the market look weak and converse for distribution trading ranges. Yeah. So that's why this takes place, as this gives the illusion of weakness. But what we can see here is that even though the price is accelerating downward, there's no real uptick in volume. If the volume was swelling here, like it does here, that would be a major sign of concern. But we don't see that. We see it kind of just kind of hanging out until it busts the low of the trading range, and then volume picks up and is sustained for the whole leg up. So yeah, context is everything here. It looks weak to the naked eye, but as we look at more of our clues, the volume just doesn't support that idea of weakness. So yeah. Okay. So any questions about any of this stuff so far? I'm going to go over, I think I have another example here before we move on. No questions about this? No. Okay, cool. Okay, so yeah, we're going to go into reaccumulation. And reaccumulation literally just looks like accumulation, but instead of it being at the bottom of the trend, typically we have accumulation and marks up, and we see the same traits that I just discussed, just following a markup period and a continuation. And we'll go over what that looks like here in a sec. So here's an example of S&P 500. Okay. Well, this is the ETF for S&P 500, but yeah. Oh, my trading range got moved. I see that. That shouldn't be there. Sorry about that. But so we see a similar anatomy to our Bitcoin trading range, where we see the price moving up, we see the price moving down, and it kind of gets confined within this range of prices. We do see a little bit of a drop below, but the main clue is after it retests the bottom, we see a strong rally to the upside that creates our sign of strength, and subsequent return to the range. Very similar to what we did before. This one's a little bit more violent though, because it comes down, retests, and then just gets shoved way below. And we see here the high volume reaction, the high spread reaction, and it just coasts right out of this range. So very similar to the accumulation setups, but this is just following the markup in our reaccumulation range. Nothing terribly unique here. It's just accumulation following markup. So go ahead and submit some questions here. But what I'm gonna get some water real quick. My throat is drying out, and I'll be back in like 2 seconds. And if you have any questions, feel free to ask. But I'm gonna get some water. Well, I'm not done, so. Okay, so we have a question here. Is there a rule of thumb for number of candles which need to make up an accumulation or distribution zone? Do you mean like literally number of candles, as in like 5 candles, 6 candles, or what do you mean specifically? Oh, you mean like a time frame? No, 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 because accumulations can. There's no like specific time frame of being, this occurs within a week. This occurs with no, nothing like that. Trading ranges can last years sometimes, and we're actually going to look at an example of something that lasted several years. Yeah. So don't think of it in terms of that. Think of it in terms of like tests. And as the trading range matures, we see a terminal test of the upper boundary, a terminal test of the lower boundary, and then it tends to decide from there. There are more nuanced cases where you can have several tests of the upper and lower boundary, but for the most part, they take this general flavor here. Yeah, there's no limit to the number of tests that can occur. There's no limit. Like sometimes a trading range can have multiple shakeouts. Okay, so let's go ahead and talk about, okay, so let's talk about the traits of distribution. Distribution, which is the top of the market cycle, is the complete opposite of accumulation. Okay, so volatility tends to increase over time. Volume tends to show spikes in supply on the declines with weaker and weaker buying responses, right? Which is the opposite of accumulation. With accumulation, we see volume spikes on demand on rallies and weaker selling responses. So these are polar opposites. And, same as the opposite same as, that doesn't make any sense. Similar to this line, the rallies within the trading range tend to occur on narrowing volume and expanding volume on the declines. Okay, so same thing as same thing, but opposite. So what I want to do here is I'm going to walk through a step-by-step identification of distribution. This was the distribution trading range we had I guess it was a couple months ago at this point. But I'm going to walk through step-by-step how I personally identify this range and the key signs as the trading range matures. Okay. So when a trading range starts, again, we don't know if it's going to be a distribution. We don't know if it's going to be a reaccumulation. But what we do know is that trading ranges tend to top with a buying climax or a selling climax. In this case, we see a very strong selling response, which indicates we have a buying climax here. And as it matures, we see as the decline matures, we see expanding spread, very high volume, until it ultimately finds its floor. Okay, nothing special there. But what this does tell us is that we see an outlier in volume. This is something that we need to kind of add to our list of clues as we go forth. Now, the only point I'm making here is we can compare this with this. Because for all we know, this is just going to end up being something like this. We can see very similar anatomy, right? So we see a very clear high, a strong reaction off the high, and we see this decline, and it kind of just does this lower low or lower high kind of thing. Very similar to what we have here. Not a spot match, but it's very similar. So we don't know going into our initial analysis whether this is going to be this or it's going to ultimately yield a distribution trading range. So it's important to be objective with our analysis. And because we did have a very clear selling effort here, we just draw a horizontal line. If this proves to be a non-point of interest, then so be it. But for right now, we're just kind of noting on our chart, this was a point of interest. Large selling interest took place here. Let's mark this line because when we return here, it's going to be a point of interest for short sellers again. Okay. Now, what's really interesting to note here is the difference in the reaction when we return to the high. We see, again, very similar anatomy, this kind of like rounding bottom thing, this series of lower highs, even the lower lows kind of look similar here. Like this is a very similar setup, but the main difference occurs. So we see this grinding effort up into the high. The main difference occurs on the reaction to the breakout. Boom and boom. Okay. If it's going to be a bullish continuation, we want to see something more like this, where we see a high spread, high volume move to the upside that doesn't break back into our range and give back up the broken resistance. But that's not what we see here. Okay? So we see our point of interest, which is the selling effort here. The price tries to break it and it fumbles right back down. And it does it on fairly, not super alarming spread, nothing that's like this, for example, but it's still relative to the move that preceded it. It's still at minimum comparable, right? And again, as the range matures, so this was our test we were just looking at, we see this decline, but in general, we still keep seeing higher lows, higher highs. And at first glance, this sort of thing is bullish. But what ends up happening is we start to see these efforts get weaker and weaker on the bull side to break out of our little range. And we can see it. So we see the same spread here and here, but look at the volume difference here. Significantly lower volume every time we test. And the spread off the reaction is consistent. Every time we break the high, it just gets spat back out to the downside. And ultimately, we start to see something immediately concerning, which is a breach of our higher low trend. So as this comes here, we see a high volume, high spread move that breaks our market structure. And this is our first sign of concern with our trading range. Doesn't mean it's lost. This could potentially become a reaccumulation trading range. But what we do know is that right now there is a hint of weakness. What ends up happening with that weakness as the trading range matures remains to be seen. But right now we're just kind of making notes here. Now again, we broke the low on high spread, high volume. Market consolidates. Does it rally? No. It once again breaks to the downside on high spread and high volume, on even higher volume. So we can see this expansion of volume on the leg down. We see a compression of price volume and price spread on the ride up. It's like flat, arguably declining, but the most important aspect here is the spread. It's compressing over time. We don't want to see this kind of stuff happening as we're breaking new highs. We don't want to see high spread, high volume moves reacting to our efforts to break out. So again, we see, okay, well, this is again another point of weakness. And now we can start to develop a trend here. We see, oh, wow, volume expansion, price spread expansion to the downside, breaking market structure. These are all signs of, well, this is a point to be concerned. We don't know where this is going to bottom. Maybe this actually comes down here and comes down here. So every time we're breaking these lows, we're kind of just taking it step by step, not trying to jump the gun. Right? So now that we've got this return back into, we see this return to somewhat bullish effort, we can see that now we can slap a trading range on here. Okay? So we've got our swing low, which is our point of interest. We've got our swing high, which is our point of interest. And then we see our main point of interest which was this massive point of supply. And we could see just how much more heavy the supply was at the beginning. So this is going to forever be a point of interest. And this will then be our point of contention that if we claim this line as support, we have a very strong bullish argument. A rejection of this just means that the supply is too strong for the market and it's most likely going to sink. Where things get interesting here is when we break the low and we rally, this actually looked like at the time this looks like a reaccumulation trading range. We see high spread, we see fairly high volume, we see another high spread move, but what we don't see is the continuation of the volume, and on the rally, volume just dies. Not only does it die, but it runs into this main point of interest here and gets rejected on high spread, high volume, expanding to the downside. Now, again, this isn't immediately alarming, but this is a sign that maybe this isn't as bullish as we were hoping it was going to be. Rejecting this level, seeing the trend of volume and spread at this stage of the trading range, this becomes a sign of trouble. If for whatever reason we continue this trend of higher highs, higher lows, and we reclaim this level, well, that's a different discussion. But until it does, when we have this major sign of trouble, the burden of proof comes on the bulls to show their hand. Because right now, all the signs are showing that the declines are expanding on high spread and high volume. The rallies are compressing on low spread and low volume. And every time the bullish effort tries to do something, it gets easily dispatched. Which brings us to almost the conclusion of the trading range, which is we see several tests of this main point of interest level. It tries to claim it. It tries to claim it. It tries to claim it until ultimately it gets spat out. And again, volume expands. This high spread move to the downside is a dead giveaway that this is not a bullish setup. This is in fact a distribution trading range. So even at any point in this, you were thinking, well, I'm not going to, maybe you're sitting in a spot long position. You're thinking, I don't want to trade this trading range. This is too choppy. What this does do is it gives you a high confidence. It gives you a high confidence trade that if this breaks to the downside on high volume and high spread, it's most likely going to continue. All the signs are there, right? We see compressing spread and volume on the rallies. We see expanding spread and volume on the declines. It breaks the high, it breaks the low, and it fails to reclaim this level. These all in combination give us a very strong confidence that if this goes to the downside, it's most likely going to continue. And that's exactly what it does, right? This is our current market top, and it led into our markdown campaign that we're currently seeing. So, with the distribution discussion, are there any questions before we move on to redistribution? Everyone's got it? Oh, all good. Cool. So redistribution. It's the same traits. It's very similar to reaccumulation. Redistribution is just the reaccumulation counterpart where, it's just a continuation of the downtrend. We see all the same characteristics. Here's a reaccumulation trading range. We see very clear horizontal levels. We can call this the range low. But, again, we see compressing spread and declining volume on the rallies. And one little trick that I like to do because this decline that led into this redistribution trading range is so big, I'd like to rescale my volume because sometimes it's not as easy to see exactly what's going on in here. It just kind of looks all flat. So what I like to do is just rescale it and chop off that bit of volume, and it makes things a lot more clear, right? So now we can see quite clearly, we've got our trading range. Expanding volume and spread on the ride down, the rally compresses. All the signs of weakness are there. We see high spread, low spread on the rallies. Yeah, all the same hallmarks as distribution, just in a continuation pattern of redistribution. Okay. So what I'm going to do now is I'm going to bring open a bunch of charts, and we're going to go through them one by one. Try not to cheat and look ahead, because the solution to the problem is there. So try to be as honest with yourself as possible. But as we go forth, let's start to work on some trading ranges here. So if this is all you've seen, right? This is a trading range that's already played out. If you already know which one this is, let's try to be objective here. But what are some of the characteristics we see in this trading range? Right, we already have, it's a fairly mature trading range. It's been consolidating for quite some time. What can we say about this trading range at the moment? Say this is present time. What do we see here? Point of interest, loss support. Are you talking about this? Yeah. That's a pretty straight line. Okay, what else? Move up into present time does not have uptrending volume. Are you talking about this? So I don't know if I would say it's not expanding. Flat volume is much better than is, descending volume. That's really what we want to not see, or see, depending on if you're long or short. Volatility overall going down over the range. Exactly. So that is one of the key takeaways here. As the range starts off, it's very violent, right? We see strong move to the upside, strong. It's like this slugging match, right? We see just bang, 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 bang. And over time, it just starts to even out. Yeah. So that's a really big takeaway from this. What else? Consolidation spends more time at the bottom of the range than the top of the range. Yeah, exactly. What else? There's a really dead giveaway here. And once I say it, you're gonna be like, oh yeah, of course. Looks like an ascending trading range. So actually, you can't see this, but this swing low got taken out. So it's not a series of higher lows. This low got taken out. So it did break some structure at some point. But what do we see with the volume, right? Overall consolidation of volume as the trading range matures. That's the big takeaway. And most specifically, on these big selling efforts, they're declining. Right? Until it starts to find its price floor, and volume stays flat. So this ends up being a reaccumulation trading range. Oh, I should have included the volume on here. I messed up. Oops. Yeah. The consolidation of volume is a major sign. Not only the consolidation of volume, but the consolidation of volatility is a major sign of bulls corralling the bears and is kind of funneling them through, going into markup. which again, in the markup campaign, we see, you'll have to take my word on it, but we see expanding spread here. And of course, ultimately, it does end up breaking this and closing above, breaking this, closing above, and finding support here. And ultimately, shooting straight up. Okay, so let's look at another one. What are some of the characteristics we see here? Bueller. Bigger spread on the down moves. Yep. For sure. Strong volume and spread on the down moves. Yep. Okay, what else? Remember, when we're looking at these trading ranges, we're in objective clue finding mode. So let's just throw all the things out there. Okay, so one, high volume / spread on declines. What else? Selling volume weakening. So I would say it's more flat than anything. Like it's not a decisively lower, it's probably relatively the same. I would say it would be getting weaker if it was something like this, and something like this, where it's like a very clear, descent. Volume and volatility both tick up about 80% through the range. I'm assuming you mean like here? Like at this point? Yeah. Volatility, at least one instance of volatility is exceptionally large. And the volume, of course, is picking up on the decline. Yep. What do we see about like the whole trading range trend of volume? Yeah, so exactly what Adam just said. Volume is weakening on the final low spread move into the current time. So the total volume is consolidating throughout this range. And additionally, a very clear uptrend, right? Although we have these large spread candles, they aren't really accomplishing a whole lot. And that's the real key takeaway here, is that they're not breaking market structure. They broke a little bit of market structure here, but they didn't break a major swing low. And we can see here that this is actually a higher low, and it failed to actually break it. Where things would get really, really sketchy is if we had the candle come down and break the market structure. But the lack of breaking of the market structure, although this was a high volume move, it didn't accomplish a whole lot. It didn't give us the, oh shit, this looks weak feeling. It gave us the, oh shit, this is scary feeling, but it's not like this is fundamentally breaking structure. And that's the most important thing, because remember, it's the context of the move relative to the previous price action. The previous price action was all higher lows, and although we had this, ultimately, it led to this massive markup campaign, right? And again, I'm an idiot. I forgot to put the volume on here, so apologies. But we can see here, I think our prior chart was right around here. But we can see here that, our main point of interest, which is about here, ultimately following the massive decline and the failure to break structure just gets easily chewed through. High volume, high move to the upside, and reclaims this zone of stuff as support before continuation. So, in this consolidation, if you're unsure, like, so say, for example, you're like, okay, we have a high volume move to the downside and a high spread move to the downside, but it's not breaking market structure, the best thing to do is just to wait. Wait for it to see how it's going to interact here, because there's a very good chance it could come up here and then it breaks the structure, right? Come back down there. But if it does this grinding move where it comes up here and reclaims it, that's a major check in the bull column, especially considering the structure of higher lows, higher highs, total volume consolidation throughout the range. The most conservative thing to do is just to wait. Wait to see how it interacts with the initial main point of interest. Okay, let's look at another one. Some of you might know what this chart is, but I purposely took the ticker off because it would be a dead giveaway. Okay, so what are some of the things we note about this? Note the time span, okay? This is 5 years. 2015 to 2020, okay? What are some of the things we notice about this trading range? Volume building throughout the range. Yep. Volume swells toward the end. Yep. What do we notice about the tests of the upper and the lower boundaries? More time spent at the top of the range, for sure. Major sign of concern. Yep, definitely. Especially as the range matures, we see consolidation. We see consolidation. Definitely a major sign of concern. What else? How about the spread? The spread off the rejections. Very high. It kind of fizzles out. Very high. Then we see another retest of the upper boundary, and ultimately a very, very violent rejection of that, and an even more violent rejection of the rejection to the upside. But the key point here is that there is I don't know if you can see this, but there's a fairly clear major point of interest that's running through this trading range, and it's this zone. Sorry, that's not a very straight line. It's this whole zone of stuff here. Market comes up, gets rejected, retests it, violently breaks it, violently rejected, violently breaks it, violently rejected. Until ultimately we see this massive move to the downside that ends up reclaiming it. So, yeah, there were a lot of bearish signs in here. But the real giveaway is at the end of the trading range when we see a terminal test of the upper or lower boundary and the reaction to that upper and lower boundary. Until that final dump and reclaim, it looked like shit. Exactly. It looked terrible. It looked like a continuation of the downtrend. Until the last minute, bang, the market shows its hand, and we see a very high volume, high spread move to the upside. And this is the chart, actually, if you don't know what it is already. It's silver. This reclaim right here is the dead giveaway. Had this market rallied and rejected this, that would be the oh shit moment. That would be the moment where you say, oh man, it's looking pretty weak. But as it reclaims this level and we see this expansion of volume going into the retest of the high, that gives us added confidence that this is going to have a sustained uptrend. And now we're kind of seeing this reaccumulation setup, right? Doesn't volume only come in after the reclaim? Yeah. So a lot of times we'll see some swelling of volume leading into the retest, but the major uptick in volume happens after this gets reclaimed. So you would call this non-typical accumulation, or am I trying to be too deterministic? No, you're trying to be too deterministic, honestly. I would call this, so this is I would call this atypical in a sense that the volume wasn't entirely reliable throughout the whole thing, because this broke some of the rules that we initially established. Right? We see expanding volume throughout the whole thing. We see crazy volatility until it ultimately resolved itself with this huge shakeout and reclaiming. So this is definitely an atypical trading range. And leading into this, had it not done this leg, this would have looked like absolute shit. This would have looked like one of the most bearish things we can see, right? Especially if the market came up and rejected this level, which we can see is a level of support. And same thing here. But this reclaim, that's the dead giveaway. That this is most likely going to continue the upside. Following the shakeout, the reclaim of this rejected level, bang. The percent moves are pretty huge as well. Yeah, they're massive. I mean, the bottom of this range, the shakeout low is 11.75. The top is almost $20. So it's like 100% price action, top to bottom. It's massive. And this is silver, Let's look at another one. What do we see here? What are some of the characteristics? Some of you might know which one this is, so I purposely chopped it off. Higher spread on the down moves, for sure. Okay, what else? Increasing volume into the second low, small spread. Increasing volume into the second low. Yeah. Volume increasing over the range, big spread on the sells, however. Yeah, exactly. We see is a sustained selling effort, for sure. There's a majorly important one that's being missed here. This high volume, high spread move breaks market structure. Exactly. There you go. Broken market structure at the end. That's the most important part of this. Broken market structure on high volume, exceptionally high volume, consistent high volume, high spread that breaks market structure and fails to reclaim it. Because ultimately, this led to our 2018 Bitcoin bear market. Right? I was such an idiot. I don't know why I left the volume off all these charts. That's like, you just have to take my word for it. Okay, let's go to another one. This one's a bit trickier. Okay. If you remember the date of this trading range, let's just try to go piece by piece. Okay. So again, same thing. What are some of the notable characteristics here? Yeah, breaking structure. Breaking structure on the initial decline. Yeah, so we see this broken structure. Yeah, we see, I mean, you can kind of do this a million times, but yeah, we're breaking structure. What else? Broken market structure at the end. Yeah, exactly. Same thing. What else? High volume and spread on the downside. High volume and spread on the downside. Yep. Volume is not consolidating. Yeah. What about the volatility? Is this increasing, decreasing, or consistent volatility throughout the range? Volume is increasing, 100%. Consistent volatility. Yep. Okay, so similar to points of interest, the main point of interest on distribution trading ranges, oftentimes in accumulation and redistribution, there's a similar sort of thing that occurs where there's a first selling effort and a second selling effort, and we have like this midline that occurs. This is like the preliminary sell-off. Is there a volatility? Wait, sorry. Is there a volatility moving average or indicator kind of like VIX? Not that I know of. I mean, volatility, you can just look at it like with your eye. You know, that's doing this rather than doing this. Also, the downward reactions off the highs are getting more aggressive rather than less aggressive. So you can see the bullish effort trying to step in off the first decline. They tried to step in on the second decline. But the third decline, the big spread, big volume, and breaking of market structure here. And ultimately, that led to a pretty epic V bottom on the S&P 500, where this time I was smart and I included the volume. But breaking this market structure was our major sign of weakness here, that the market isn't as strong as we think. The failed rally and return to the broken market structure, bang, it just keeps going. And we see this epic blow off to the downside. No. Okay. Make sense so far? I think I have a couple more examples. So this one's a real challenging one. I purposely kept the ticker off because you might already know what this is. So what do we see here? This is a really complex trading range. We see two trading ranges actually. Mad Mike knows which one this is. What do we note about the volume, the structure, all that fun stuff that we've been talking about? Volume is not decreasing. No, it is not. What about the spread and the volume associated with the spread? Spread seems consistent. Yeah, consistent, like just scribbles, right? Spread on the upside actually looks bigger. Yep. And what about the spread on the downside? Very, very tight. Although the selling effort is increasing, the result is not. And although we do break market structure, this is a very sign of concern. This is a point of concern, a POC. this is going to raise some eyebrows, because once we break this market structure, we see this massive expansion of price, the spread and volume, and it comes up, initially rejects it, and it gets back inside. But the big takeaway here is that we rally after breaking the market structure. If the market would have come up, get out of here. Let me get this thing. What did I do? Get out of here. Oh my God. I was doing so well. Can I just get rid of this freaking ruler? Hold on. There we go. Okay. So we see the broken market structure. We see this high spread move to the downside. It tries to get back inside, fails, comes back down. Tries to get back inside, and we see a very consistent level here that if we show major signs of weakness in the market, we would expect this to get rejected and continue down. But that's not what we see. We see this major level here get broken on expanding volume, on massive spread, and it refines its support there. So if you don't already know what this is Tesla. That was Tesla. And we were looking at this. So we see this reclaim here, and it just sails up on high spread, high volume, and just goes on this epic parabolic bull market. Let's see. Do I got any more? Oh, here we go. All right, so now we've gone through a ton of examples. Let's talk about how to actually trade it, right? Like, this is all good, all well and good, but until you know how to actually trade it, like, it's not very actionable, is it? So once we identify that a trading range exists, right? Because again, we want to resist the urge to just slap trading ranges on every piece of price action. What we want to look for is key monumental pieces of price action where we see, a strong move up and then bang, high rejection on high volume. And this gives us our main point of interest, or MPOC, right? That's going to set the range high. We look for it to define a range low. And once we've got a trading range identified, that's when we're going to start to do our work. Until then, until we've identified a trading range, it's just, trends. However, it's important to keep in mind that when we're analyzing a trading range, the whole point isn't to jump the gun. It's to compile as many clues as possible. What is the price spread doing? Is it compressing? Is it expanding? At what point in the trading range is it? Is the spread contracting or spreading after a terminal test of the upper or lower boundary? All of these things are very important because context is king. Okay? And that is going to allow us to get further and further confidence regarding the type of the trading range. And so whether you want to trade the trading range or not remains to be seen. But what you can start to do at minimum, the safest thing you can do, is get clues as to what your plan should be for markup or markdown. If we see broken market structure to the downside, we want to have a plan, right? You don't just want to sit there and ride out an epic distribution range that leads into a profound markdown. You don't want to sit there and just eat the loss. That's silly. The safest way to play the accumulation trading range is to buy the reclaimed level of interest. So let's go back a little bit. I'll go to a simple example. It's a lot of charts, sorry. Here, we'll use this one. So buy the reclaimed level of interest. In this particular case, this is a zone, because it's kind of just like this whole little zone of price action. And following the terminal test of the upside, subsequent strong rally following the terminal test of the downside, we would want to buy this little pullback. This is the safest way we can trade this accumulation trading range. This is a very high confidence play, and vice versa. If you're trying to trade a distribution trading range, we look for stuff like this. The sign of trouble, the initial sign of trouble. If you don't want to, one of the easiest ways you can play this, and this is actually how Jack played it. If you follow Crypto Jack on Twitter, this is how we played it. We played it a little differently. Was he said, I'm going to just get out of the market here and go to cash. And if it continues up and reclaims, then I'll just buy a little bit higher. But for sure, there's a main point of interest, a high volume zone that keeps getting rejected over and over and over again. Next time it comes up here, you just get out of the market. And once it shows its hand and it reclaims this, or comes up and reclaims this, or shows some strength to the upside, then you re-enter the market and you just say, okay, eating this bit of price action just isn't worth the risk of eating this bit of price action, right? So you can take this, or if you want to be really sure, you don't sell the main point of interest level. You sell the breach and failure to reclaim the broken trading range. So this is the main sign of concern. And so once it closes below and fails to reclaim this broken level, that would be, a really nice spot to start taking some risk off. Okay. So I didn't even have to scroll back up. Okay. So at this point, I've talked to you guys for the last 2 hours straight. What questions do you guys have, or what examples you want me to go back over, or whatever? Ask away. Unless you're all professional trading range analysts now. Digesting it all. I think after spending a few days looking at charts, I might have some more questions. Yeah, totally fair. I mean, it's a lot to take in. And to be honest with you, most of trading range analysis is fairly simple. It's just constantly reminding yourself to be objective is the hard part. And to be like, okay, what is it doing now relative to what it was doing? How is price interacting with the main point of interest, or the structures at the bottom, or the structures at the top? Those are where the real juicy pieces of detail emerge. The main point of interest is something I totally missed in my trading range analysis so far. Yeah, so the main point of interest is the whole premise. The main point of interest is the whole premise behind my favorite setup. Oh, I didn't even have an example here. My favorite setup, which is, I'll just draw it on here, which is, you've probably heard me call it this before, but the meme head and shoulders. And the setup is very similar to this setup, but it makes this initial level, makes a high, breaks the structure, comes back up, and reclaims this main point of interest here. And the reclaim here is what gives us the major confidence that it's going to continue up. But I think that's probably information overload if I go into that stuff. Definitely a new way of looking at things, but explains moves I'm seeing lately for short-term moves, which lead to good short-term trades. Main point of interest is huge for me too. Yeah, it's really important because it's like it's the line in the sand, here, the line in the sand. Can we conquer this? If not, we're going down. If we conquer this and we have all these other supporting pieces of evidence, like we discussed here, consolidating volume, the spread, the point of interest, all of these things in conjunction yield a higher point of confidence as the range matures. And that's how you need to think about it. And it's okay when a trading range starts to develop. If you're unsure, you're like, okay, I don't know what's going on, but I'm going to sit here for a few days and until it starts to rear its ugly head. Let me know exactly what the intent is here. The whole point of trading ranges is to allow big money, people who could potentially slip the market if they trade large size, to enter and exit the market efficiently through a series of tests, right? This gives them all the details they're looking for, and it informs big money as to what they should be doing. And they're looking at the same information we are, If there's overwhelming supply, they're thinking, okay, well, I should probably get out of the market. I can't support this. If it's consolidating volume and there's consistent bullish effort from retail traders, well, that gives us confidence of a markup campaign. All these things come together to form one relatively strong idea. And I'll go through this prior example too, because I remember this was one that the Wyckoff Institute, the guys who are the OGs of trading range analysis, they got wrong. I don't know why they got wrong, because this is such a textbook distribution trading range, but they were thinking that this was a reaccumulation trading range. And in their defense, up until this stuff started, showing up, where it's compressed spread, declining volume, this looked like a reaccumulation trading range where you had a spring and a bounce to the upside. But the real signal and sign occurred in the last stage of the trading range, where it said, okay, this is fully matured. It's not sustainable. It's just not supporting any bullish effort. Supply is overwhelming. It's on shaky legs, and the foundation of the house is just about to bust. And that's what it ends up doing. I tend to have them marked in my charts, but just as a level and not with enough importance behind it. Yeah, dude. I'm assuming you mean the main point of interest. Yeah, for sure. No. Any chance we could see what clues we can gather about the current range? Yeah, of course. Understand if you don't want to give commentary about current market. Yeah. No, we'll for sure talk about the current market. I think I have one more section before we start talking about the current market, but we'll for sure go through it. Okay. So yeah. So this next little section, we're going to compare two similar but subtly different trading ranges. Okay. So we're going to compare this one. First, let's make some notes. Okay. Let's start to gather some clues. This is your first time looking at this chart. What do we see? Number one, first thing that we see. First thing that comes to mind. Compressing volatility. Okay, what else? High spread red candle rejections from the highs. Yes, big time. Okay. Broken market structure, but rallied out of it on the 23rd. Yes. Broken market structure. More time at the bottom of the range. Bingo. So most of the time spent is at the bottom of the range rather than in the top part of the range. Okay. Current actions trying to reclaim the POI. There we go. So this one's a little bit more complicated because you can see it's not a clean zone. I would argue that this little hiccup here, all this kind of stuff here, anything in here, this is the main point of interest, right? Because it kind of made like this kind of thing here where it like had several tests and then rejected. So yeah. Potential reclaim. I'll say potential reclaim of POI. Yep. Anything else? POI is maybe big volume on the 17th. Which one's the 17th? 17th is here. So when we're identifying the POI, we want to see where the market finds its rejection level. It's not necessarily where the volume picks up. It's more so where the market comes up and it says, this is unsustainable, and it gets rejected. Sometimes it's a clean swing high. Sometimes it's a zone. But it's a general idea of like, this is where the market's unsure of holding. First sign of trouble is the 14th. 14th here. Yep, exactly. That's also true. When we're riding up, we see supply starting to pick up. We see volatility pick up, and it pushes onward. So we can already see that this is a decisively different bit of price action from that preceded it. So although this isn't immediately actionable for the larger trading range, at the time, if you're only looking at this part, it says, okay, something's a brewing here. There's some supply interest here. Doesn't necessarily mean close your longs, but what it does say is, okay, maybe it's time to start paying attention and take a close look as to what's going on. Okay, anything else? How about the price action following the broken market structure, right? So we take out this low on high volume. It gets quickly dispatched with this giant wick. And we see this nice reduction in volatility, and we see higher lows until ultimately we see this nice big high volume, high spread out of this lower part, and it starts ramming into here. Okay, so let's look at the next little guy. And of course, you guessed it at this point. It's a reaccumulation trading range, right? So here's the POI. And sometimes the POI isn't always as clean as just going up like this and retesting. Sometimes it comes up and it just kind of grinds through it. And this is totally fine. This is a little bit harder to trade, but as long as you have the context of the POI level, this grind can be a nice entry, because you can see. Can I make this smaller? You can buy this level and maybe put a stop below this swing low, something like that. Buying this chop is a little harder. But that is definitely at minimum. Once this level gets reclaimed and it starts to mark up, that's a major sign that of impending strength. Okay, so let's look at one that's similar. Okay, so I'll flip back and forth so you can see. Fairly similar, but subtly different. Okay, so we can see here that in the previous example, we had what looked like kind of like a head and shoulders kind of thing. You can argue a head and shoulders down here. And we see the same sort of thing. Oops, shit. Oh, no. So we see the same sort of thing here. We've got this like head and shoulders kind of thing. We've got this high volume rejection, so we can kind of mark this high as like the POI. What are some of the things that come to mind with this chart? Fresh set of eyes. What do we see here? So 1, rejected from the POI. Yeah. Reject at POI. Okay, what else? Bad spread on second rejection. Do you mean this, or do you mean which one do you mean? Consistent yeah, it's a good one too. Consistent volatility throughout the range, right? It just kind of never really chills out, right? It has no chill. It's just going nuts. Consistent volatility. Let's say consistent volatility. Okay. Yeah. Okay. So what else? Let's list them all out. Volume is not consolidating. Definitely not, right? No consolidation here. Volume is not consolidating. What else? What about the spread? What can we say about the spread here? Weak volume of the low. What do you mean by weak volume of the low? Spread much bigger on the down. Yeah, consistently, right? I mean, look at that guy. Look at this guy. Look at this guy. And compare that to the rallies. High spread, high volume on the sells, and large buy volumes are mostly on small spread candles. Yes, exactly. So we'll just say bearish spread to volume. Consistently, right? Anything else we can say? There's a major difference here that no one's gotten yet. Just super obvious. More time spent in the top. Yeah, it's another one. That's not even what I was thinking of, but that's time at top. This was when you tweeted ETH was going to 1400. Do you remember when in the range you said that? I think I initially said it like right in here. I don't recall immediately, but when it broke back below in here and failed to rally back above, I think I tweeted it like right in here. Failed to reclaim POI at the end. Yeah, so we have that one. So Mike hit the nail on the head here. 6. We keep breaking structure downward. Broken structure over and over again, right? Bang. Bang. And we start to see consolidations at the lows where it tries to rally and it goes, nah, I can't do it. And Adam hit the hit the nail on the head, because this was Ether. So look at the difference here. Here's our POI. Tries, fails, tries again, fails. And what do we see after the POI? Because remember, it's all about the reaction. Because we could see something like this where it comes up and grinds through. Okay? But what we see here on the reaction to that level is expanding spread and expanding volume consistently following this failed retest here. And this is what brings us into our current Ether market. I think I have the slide here. No, I don't. But yeah. So this is a perfect example of why you shouldn't look at trading ranges as patterns, because these look, you could, if you were bullishly biased, you could look at this and say, this looks bullish to me because it looks like this consolidation. But they're subtly different in the way the context of the spread and the volume interacts with one another throughout the range. Totally different. Night and day difference. Now, it should be noted at this point that trading ranges can be incredibly complicated and incredibly hard to read. You know, they're not always going to be as cut and dry as this, right? Like we might have an example like silver was. Like that was a very difficult range to identify until the very end. It's like the last second. This was the dead giveaway here. Throughout the whole range, this was a hard one to read. This looked like redistribution. Had expanding volume all the time spent at the top of the range. But the major clue was this final reaction here. So, you know, I know a lot of people give people like myself who use trading range analysis with their trading, they give them a lot of shit because they're like, oh, you're flipping your bias. But it's like, really what's happening is we're just, you know, collecting clues. And each time we collect a clue, that adds or decreases to our level of confidence. And as the range matures, so should our confidence level. And be ready to change. You know, you could be 80% sure, like, oh man, this looks like a redistribution. But this final reaction, that fights back, and it has important anatomy that is consistent with accumulation. So, you know, sometimes it can be really complicated like this, or the Tesla example. That one was a hard one as well, right? Where is it? Like this looks like a freaking kindergartner just went over to their wall and was just like drawing with crayons. Like this looks terrible. But then the end is what gives us, you know, the final clue as to what's going on. It can be a mystery for months. You know, this is a 2-year-long trading range. Or 3-year-long trading range. 3 years. Preceded by another 3 years. So like these things can take massive amounts of time. So it's important to remain objective when we're seeing the tests of the upper and lower boundaries, and especially when we see these terminal tests that break structure. Because if they break structure and they reclaim and they pop back up, we got a real strong bullish argument. But if it breaks the structure and it fails to rally, that's when we're going to have added confidence for our bearish bias. So with that in mind, before I go to the current market, do you guys have any more questions or comments on the trading range stuff? Or literally anything that we've gone over so far? Give you guys a second to collect your thoughts. Okay, so this is a really important question. Does time frame really not matter for trading range analysis? As in, it will work on 5-minute charts as well as 1-day charts. Of course, the trade will be shorter on 5-minute charts. So, what's important to note is that the lower the time frame, the lower the liquidity, and the more prone to false signals you will get. So while it is possible to do trading range, and I do trading range analysis on 5 and 15-minute charts all the time, it's important to keep in mind that the higher the time frame, the higher the precedence. I'm very much interested in seeing where and why you would put the POI and on the current range as the initial entry into the range was so volatile. Wait, say that again? Are you talking about this specific chart here? This one? Current market. The current Bitcoin market? Okay, let me pull up my chart. Okay, so your question is, let me see it again. Where and why you would put the POI on the current range as the initial entry into the range was so volatile. What do you mean? Oops, that's not. The long wicks make it so hard to define the TR boundaries. Yeah, so for me, with the current trading range, I have it, yeah, it is very volatile. But the way I see the trading range currently is something like this. Because this had such an outsized reaction here. And so for me, the initial point of interest is going to be this zone of shit right here. Or if you wanted to be really conservative, you'd move it up higher, something like this. You know, something like that. That would be a very high, like if we get back up here, that'd be a very high confidence play. So, and the reason for that is, I'll just keep using my Wacom tablet here. Is because this thing has been rejected so many freaking times. And it even saw a breach of the trading range high, and now a terminal shakeout of the trading range low. And right now it's kind of just like figuring out what it wants to do. But it is making higher lows, higher highs. Total volume, you could argue, is consolidating. But what I really don't want to see, so because this is such a volatile range, I would actually break this up into 2 pieces. This is how I have it on my other chart. So I would break this up into 2 pieces. Something like this. Something like that. You know, if you're doing Wyckoff analysis, these would be like the 2 creeks. Where we can see quite clearly like this formed a temporary bottom, and it's kind of just like oscillating around this general line. It formed, you know, as a local top here. From here, like we definitely don't want to see it getting rejected here. But the rejection has been fairly weak so far. You know, like there's no notable volume. There's no notable real spread off of this. It got rejected at the time. That was a bad sign, but it was, you know, the follow through is just non-existent. If we can, however, come up here and reclaim this level, especially following the shakeout, the break of the market structure, that'd be a nice check in the bull column here. And the final check in the bull column would be we come here and come up here. But until this level gets reclaimed, I don't have any reason to be bullish here. Especially when we look at like how it's consistently closing lower lows. You know? It's just this is the test I'm personally waiting for before I flip my bearish bias. If we can flip that, I'll be like, okay, that's great. That's a nice break of the bearish market structure. You know, we talk about the break of the bearish structure. We talk about the break of the bullish structure here. Well, we can say that we can use the same logic here. Well, this is consistently a level of rejection. If we can come up here and reclaim that, cool. If we can come up here and reclaim this, then that's game on. If we get to this level here, this is like super, super high confidence play. Again, it also matters the way in which we arrive there. If we get high volume, high spread, especially if it's, you know, expanding on the way up, that's super high confidence move. If we get this grinding move like this on flat volume, that's also a pretty high confidence move. What we don't want to see, however, is we don't want to see something like this, where we see the spread. I'll zoom in a little closer. Where we see the spread starting off wide and just compressing toward the end, and overall volume just dies out. You know, on this ride up, we see. Well, to be fair, it wasn't dying out. It was kind of more flat than anything. The spread was dying out, and ultimately got rejected by this massive spread rejection. But you know, if we see something like that, where it's tight spread running into this level, and the volume is decreasing, that gives me more vibes like this. You know, our prior range that we discussed a ton of times. We could have a move like this, where it looks strong at face value, but it's the follow through that just kind of dies. It dies, you know, right at this important level. And if we see that happen again, well, that's most likely going to be a continuation of to the downside. If we see it petering up on decreasing volume, spread tightens, it sits here and hesitates. You know, maybe it comes up like this, and it's like it comes up, and it's like. And we see these massive, like this is a major sign of concern. Same thing here. If we come up here and it just kind of compresses and it's like, it's trying, and then massive rejection, that's going to be the major sign of concern. Right now, the trend is down. We broke out of a macro distribution trading range. This is our first major consolidation. Until this starts breaking these barriers, I don't see a huge argument for an accumulation trading range just yet. You know, we had a rejection here. You know, not a ton of supply surfaced on the ride down. Big rejection here. But the fact that it's faltering here and it hasn't broken this yet, that means by default, you know, that puts us in this kind of territory here. You know? Because it's like sitting there just beating this level, and maybe it makes a little bit of a higher high, but if it gets rejected, the way in which it gets rejected will tell us everything. Does that answer your question? Yeah, and especially because we're seeing, like, if we look at the daily chart, for example, this becomes even more clear that we're just, you know, this becomes a lot more similar to one of the examples we were looking at before of redistribution, the lower time frame redistribution. This looks very, when we look at it like this, where it's like there's a very clear level here and it just isn't breaking it, but it's breaking support structure. This looks very similar to this. To a trading range like this. Or a trading range like this. you know. It breaks down and it fails to reclaim this zone, this like mid zone. Same thing here. And we can make the same argument here on the daily chart. So where the real interesting stuff will start to take place is if we can break this. But until that's broken, I mean, it's a bear market, you know. So, Adam, does that answer your question about the current market? Completely. Cool. Man, this has definitely been the longest I've talked in a long time. It's almost 3 hours straight. But I think next weekend I'll be able to trim some fat off this and make it a little more less labor intensive. Do you guys have any questions before we end this thing? Did this discussion make things more clear, less clear? Do you feel like the goals set at the beginning of the class were met? You know. Wish I had this when Ether was still above 4K. Yeah, I know. Sorry. Awesome. Well, I was worried that it was going to be a little too dense. You know, it's really easy to like just beat people over the head with this kind of analysis, and it just gets kind of cumbersome. But I hope that you know, at least you'll have some valuable reference material at minimum to go back and say, here's some historic examples. You know, here's some notes we took on the trading ranges, that kind of stuff. Because that was kind of the goal, was not only to equip you guys with a tool set, but you know, have some reference material as well that you can look back on and kind of keep yourself in check. Because, dude, I still reference blog entries from like 5 or 6 years ago still. You know, like just to keep myself in check. I'm like, am I being objective? And if you're not being objective, you're gonna break your own heart, you know. Recommend saving specific segments of this class as distinct video clips. Yeah, so I'll have to actually go back and do some editing, because I realized a couple of times when I muted my microphone, I didn't mute the recording. So there's going to be random times where I'm like scolding my dog for chewing on something just in the middle of the lecture. So yeah, I'll have to do some editing. I'll have to go back and look through it. Hopefully the goal is that the trading range analysis seems less like voodoo bullshit, because I think most people, when they're first learning it, they're like, this just seems like hindsight garbage. Good moment to shill the Discord. Yeah, I mean, I'll just leave it at that for right now. So I think I'm going to record the second class too, because it'll be a little bit smoother, I imagine. But yeah, any recommendations you guys have, or comments, you know, shoot me a DM. You know, if you felt like something could have been explained better, or whatever. You know, I'd like to My goal is to make this a semi-regular thing, you know, like maybe once a month, once every few weeks, where I'm going to, I don't know if you noticed, but at the beginning of the notes, it was a 101 class. And my goal is to make this a more comprehensive, all-encompassing series that you can go back years later and from scratch, looking at any blank chart, you can build a trading plan based off of various aspects of trading, you know, not just trading range analysis, but trend analysis. Ultimately have some risk management stuff in there. Like just, I have to all these discrete tool sets. But in my opinion, before you even get to those points, you need to understand why the markets move. What are the forces that make the markets move? What does market weakness objectively look like? What phase of the market cycle are we in? You know, that sort of stuff is like really crucial in my opinion. The session was priceless. Well, technically it did have a price, so it wasn't priceless. But yeah, thanks, man. I appreciate that. Especially because I want to do this in lieu of doing live streams. Live streams are just so impersonal. You can't actually have conversations with people. You know, I feel like this is a lot better. I'd much rather have a smaller group of people that actually care about learning than just giving price targets and shit. That stuff is soul sucking. Okay, so I guess let's go ahead and end it because it's the 4th of July weekend. Well, if you're American anyway. And yeah, so I'll end the recording. I'll try to have this like edited and fixed up by midweek. And I think I'll do what Molzer said and break it up into segments. So rather than looking through a 3-hour video, you can be like, okay, this is the section on accumulation. This is the section on distribution. You know, stuff like that. So I think that'll probably be a bit more useful too. Anyway, yeah, go ahead and if you have any more comments or questions for that matter, you know, hit me up and then we'll reconvene on next weekend. And if you're interested in taking the class again, cool. And if not, then that's also cool. But you guys have a great weekend, and I'm going to end the recording now.